The United States stock market is closed right now, as today is Saturday, June 13th, 2026. Datavault AI Inc., which trades on the NASDAQ under the ticker symbol DVLT, ended its last live trading session on Friday, June 12, 2026, at a closing price of $0.36 per share, marking a decline of nearly 9% over the course of the week and holding a market capitalization of around $306 million. While the headline numbers show a struggling microcap stock trading under $1, the real story here is the massive gap between what the company claims it is building and what the public markets are actually pricing in. Most people look at Datavault AI Inc. and see an identity crisis, considering it was known as WISA Technologies until a major rebranding earlier last year, but the reality is a high-stakes compliance battle that could completely alter its survival. Just this week, a prominent shareholder rights law firm announced an investigation into whether the company's officers violated securities laws following a devastating short report that accused the firm of being a mere promotional entity with empty claims around blockchain marketplaces and asset tokenization. This creates an intense curiosity loop, because while the company is out there signing non-binding term sheets for a massive $2 billion structured financing arrangement to fund its global tokenization mandate, the market is treating the equity like a ticking clock, creating an absolute mismatch between executive ambition and street-level skepticism. To understand where Datavault AI Inc. is going, you have to look at how retail traders approach this asset compared to institutional players. If you look at popular online investing sites or the social feeds of self-investing communities, there is a general belief that any company with AI in its name that drops below 50 cents is a prime candidate for a massive short squeeze or a speculative breakout. People look at heavy trading volumes, which recently averaged over 56 million shares, and assume that massive liquidity means institutional accumulating. But when you challenge that common ground with a deeper look at insider behavior, the narrative begins to crack. For example, just days ago, the company's own chief accounting officer and vice president of finance sold over 62,000 shares of common stock. When the person managing the ledger is liquidating shares into weekly weakness, it forces smart investors to rethink the entire thesis. It shows that while retail traders are using retail platforms to buy fractional shares hoping for a quick double, the people inside the room are treating the current equity structure with extreme caution. This divergence between perception and reality is exactly what drives wild intraday swings. When you track the daily momentum of a stock like Datavault AI Inc., you are looking at an arena driven entirely by retail sentiment, small-scale algorithmic trading, and short position coverage. The trading volume itself tells an incredible story of speculative churn, where the entire outstanding share base of the company seems to turn over every few weeks. This is not the type of steady accumulation you see with mega-cap choices like Tesla stock or Nvidia stock, where institutional asset managers build long-term positions through sophisticated algorithms. Instead, Datavault AI Inc. experiences massive spikes in volume whenever a new press release hits the wire, followed by slow, bleeding sell-offs as the reality of financing dilution sets in. Institutional activity here is almost entirely absent on the long side, leaving the stock vulnerable to extreme volatility. If you are involved in self-investing or managing your own individual brokerage account, navigating a microcap asset requires recognizing that volume does not always equal validation. Often, high volume at these price levels simply means high velocity exiting by early investors, or note holders converting debt into equity and selling it immediately into the open market. Comment below how many shares of Datavault AI Inc. you currently hold, or if you are completely avoiding microcap technology stocks in the current economic environment. The pressure on Datavault AI Inc. is compounded by massive macroeconomic headwinds and sector-specific momentum shifts. Over the past year, the broader technology sector has been heavily bifurcated. Large-cap companies with real, cash-flowing business models have seen massive capital inflows, while speculative, pre-revenue, or low-margin microcaps have been completely starved of liquidity. When retail participants look for investment help, traditional wealth management platforms often steer them towards conservative choices or established diversified funds rather than speculative technology plays. This macro setup means that small companies cannot just rely on promises anymore. They have to defend their capital structure. Datavault AI Inc. recently had to execute a $60 million public offering of common stock to keep the lights on and fund its expansion. While an influx of $60 million provides an immediate operational runway, it acts as a massive anchor on the share price because it drastically increases the total shares outstanding, diluting existing retail holders who bought in at higher levels. This dilution is the primary reason the stock has declined over 50% during the past year, despite putting out a near constant stream of highly ambitious press releases. To truly grasp the operational reality, we have to look past the current trading chaos and look at what this business actually does. At its core, Datavault AI Inc. operates as a data sciences and technology company that attempts to bridge the gap between advanced data management, artificial intelligence, and real-world asset tokenization. The business model relies on proprietary platforms designed to secure, value, and monetize corporate data assets. They market specialized AI agents intended to help organizations streamline financial modeling and risk assessment without triggering regulatory compliance issues. Furthermore, the company maintains an acoustic sciences division, which is the legacy remnant of its past identity as WISA Technologies. This division focuses on wireless audio standards, data over sound technologies, and spatial audio solutions. The corporate strategy relies on a dual-track approach, using the steady, tangible intellectual property of wireless audio to provide a baseline of commercial validity, while aggressively pivoting into the Web3 space, where data assets can be tokenized on a blockchain and traded globally. The historical financial reports highlight the intense financial strain this dual model creates. Looking at the recent quarterly filings leading into early 26, the company's revenue lines have shown massive erratic fluctuations. For instance, while they recorded a significant revenue spike of over $33 million in the final quarter of last year, their operating expenses have consistently escalated, frequently topping $30 million a quarter due to massive research and development outlays and heavy selling, general, and administrative costs. The structural reality is that the company is burning through cash at a rapid rate to support its high-tech ambitions. Even though their first quarter earnings report for 26 technically beat consensus expectations by posting a smaller loss per share than analysts predicted, an unexpected beat on a negative number still means the company is losing cash operations-wise. For self-investing individuals evaluating the company's past performance, the core takeaway is that the business has historically relied heavily on continuous equity financing and stock issuances to offset its operational cash burn, creating a permanent friction point for long-term price appreciation. Looking ahead, the future outlook for Datavault AI Inc. is defined by a series of highly volatile binary catalysts that will either lift the stock out of the penny stock basement or result in further structural decline. The most significant near-term variable is the execution of their proposed $2 billion structured financing term sheet. If this deal transitions from a non-binding agreement to a fully executed capital-delivering contract, it would provide the company with an unprecedented level of financial backing, completely changing the reality of its balance sheet. The strategy behind this financing is tied to a global tokenization mandate, where Datavault AI Inc. intends to list massive real-world asset programs, such as copper and gold mining projects, on digital exchange platforms. If these tokenization programs gain actual commercial traction and generate measurable transactional fees, the company could establish a high-margin, repeatable revenue stream that shifts the market narrative away from speculation and towards tangible fundamental value. However, the risks clouding this future outlook are substantial and cannot be ignored by anyone practicing active online investing. The ongoing securities law investigations and the shadow of the short report present an immediate threat to market confidence. If regulatory bodies or legal challenges validate the claims that the company's data monetization and artificial intelligence capabilities are overstated, the stock could face catastrophic institutional abandonment and potential delisting notices from the exchange due to maintaining a share price well below the $1 minimum requirement. Additionally, management's plan to explore a dividend spin-out of its acoustic sciences division into a separate, standalone public company introduces massive structural complexity. While a spin-out can sometimes unlock hidden value for shareholders, it also risks stripping the parent company of its most stable, tangible technology assets, leaving Datavault AI Inc. as a pure-play speculative bet on the unproven market for asset tokenization. When you synthesize the entire situation, the stark contrast between expectation and reality becomes the defining feature of Datavault AI Inc. The market expectation, as reflected in the sub-dollar stock price and heavy short interest, is that the company is a highly promotional microcap struggling to cover its operating costs while facing legal and structural scrutiny. The corporate reality, or at least the narrative management is actively selling, is that of a technology pioneer sitting on the cusp of managing billions of dollars in tokenized real-world assets through advanced data systems. For retail participants managing an individual brokerage account, this asset represents the absolute extreme of high-risk, high-reward speculation. It is a stock driven entirely by headlines, filings, and structural liquidity, rather than stable cash flows or predictable sector trends. Whether the company can successfully navigate its legal hurdles, avoid permanent equity dilution, and turn its massive asset tokenization agreements into actual operating revenue remains the ultimate question that will dictate its long-term survival in the public markets.